So, welcome. I'm Terry Cook. I'm CEO of the Hamilton Community Foundation, and it is my pleasure on behalf of our board and our staff team to welcome together so many friends of the foundation, former board members, fund holders, supporters, colleagues from Burlington and Oakville, and I believe Toronto. I don't know if any of the Toronto folks have arrived yet, but that'll depend on traffic. It's entirely appropriate that we meet here, really in the receptacle of a place that was the vision of Thomas McQuestion, the great builder, Hamilton's greatest builder, right? Because at a time when, during the Depression, people weren't thinking optimistically or in a visionary way about the future, he said we should take an old quarry and turn it into a world-class garden. He was the creator of the Queen Elizabeth Way, McMaster University, the Hamilton Parks Board, the champion of the rainbow and blue water bridges, and a visionary that very much would have been at home in a conversation about the Hamilton Community Foundation and the work we have done around environmental stewardship. And today we're here really to talk a little bit about not our history granting to environmental causes, which we've been very proud of over the 65 years that we've been around, but in the ways in which we have used all of our assets, the capacity of our capital to make a difference, not only in Hamilton, but around the world. And I want to give you a quick history before I actually get to the content on the panel, because about 8 years ago, we had what for us was a historic board retreat. And Sandra Stevenson was there because she was the board chair that hired me and presided in those early years. I mean, you made a momentary lapse in judgment on that one, but otherwise you were obviously a great board chair. And we had Bill Young Jr. come and talk to that retreat. And we invited two of our really foundational leaders and donors, former board chairs, Murray Hogarth, who is now passed, and Terry Yates, who thankfully has not passed, and he's sitting in the fourth row, ready to heckle the speaker here if he doesn't pass the mic soon. And at that board retreat, Bill Young said, you know, it's great what the Hamilton Community Foundation has done in building from that first gift of $200 from a widow in the north end of Hamilton to about $190 million in assets today. And the granting that you do, about $8 million a year to important charities and nonprofits in Hamilton. It's great what you do with 3.5% of your assets. What are you doing with the other 96.5%? And why aren't you following the lead of some great private foundations in the UK, the US, and in other parts of Canada that in fact have started to align all of their assets with their mission? And it was at that board meeting that, led by Murray Hogarth and Terry Yates and our board at the time, they said, let's take an initial $5 million of unrestricted capital and see if we can invest in private sector companies that not only pay a financial return, but also do good in the world. And if we can make loans to charities and nonprofits that will strengthen their capacity. And what I have to tell you is, 7.5 years later, and I think we have 27 or 28 active investments or loans, touch wood, none of which have gone sideways to date, that have demonstrated very clearly that through that learning journey and that vision encouraged by successive boards, that we have been able not only to do the granting that remains important in this community, but very much to use a bunch of other tools in the tool chest to broaden our reach and to leverage the assets that have been entrusted to us. And most recently, you'll hear from Annette Ainquin in a minute, we did a piece of work with Mercer that looked at the long-term sustainability of our foundation in conjunction with our board's stated goal of having 20% of our assets directly invested for impact by 2020, which will put us at the leading edge of Canadian impact investors, along with folks like the Edmonton Community Foundation, the McConnell Private Foundation, and a few others that we tend to do business with. And they're providing real comfort to us. And in a nutshell, they were these things. One, that in investing for environmental, social, or human rights benefit, in addition to for financial return, we are not conceding financial return over the long term. We, in fact, are in many ways diversifying and strengthening our ability to deal with market turbulence. And secondly, what they said is, this is an area of growing opportunity for foundations like ours to broaden our reach, to widen our horizon and to partner with companies and nonprofits that are prepared to be good stewards of our assets, but also to do good in the world. So with that, tonight we're going to provide a panel of 3 completely different investments and loans that we've committed to over the last number of years. One with an international focus, one with a national focus, and one right here in our own backyard. In fact, the middle one that you hear about, the Eco Park, is something that a number of people in this room have been actively involved in as donors, as champions, as supporters. And it's the vision really that builds on Weston's historic vision of knitting together Cootes Paradise and the Escarpment and protecting a green belt forever for good. And that's something that Bob Crockford's been a champion of, and Hugh Clark, who's coming in now, has been a champion of. I can hear his voice already. And Frank Miller has fundamentally and generously contributed to. And you're going to hear a little bit about our role in that. But before I do that, and before I introduce our other 2 panelists, Jen Baker's going to speak from the Naturalist Club on the Eco Park. We have John Cook here from Greenchip, who's going to talk about that focused environmental investment. And then we're going to have Trish Nixon talk about the work of CoPower. But before I do that, I'm going to ask my VP of Finance and Operations, Annette Aikman, to come and talk to you a little bit about the journey that we've been on and place in context our social impact investments. And in doing that, let me say, first of all, that anytime in leadership you have somebody that is your head of finance that really buys into the broader vision of aligning your values with your assets, you're really lucky. We in Hamilton happen to be doubly blessed. Annette is not only a credible voice for impact investing in this community foundation, but she's nationally and internationally recognized for the leadership that she's provided. She's been the spiritual leader of this work for us, and without her, we would be a much poorer foundation. So with that underwhelming introduction, Annette Aikman, come and talk to us.
Just to be clear, he never says that to me when I'm in the office. Ever.
That's true.
Just So, Terry's done a pretty good job outlining kind of how we made this journey over the last 8 years on impact investing. I thought I have a visual here that, nobody can possibly see the numbers, so, don't think I'm trying to be deceptive by, making small numbers. This is kind of the way the Hamilton Community Foundation thinks about impact investing. So when we think about whatever we do at the foundation, it's always focused on our mission, vision, and values, everything we do every day. When we look at the first ring around that mission, vision, and values, obviously to Terry's point, granting and community leadership are an enormous part of what we do and wake up to do every single day. That currently stands at about $7.3 to $7.5 million a year, and we've granted over $100 million since our inception. The next kind of ring around that is what Terry was mentioning was our first kind of commitment to local community investing. So the Hamilton Community Foundation provides loans to charities, not-for-profits, and social enterprise in Hamilton. So again, this helps bolster the capacity of our local charities, and sometimes actually is the impetus to allow them to really expand the effort and the work they do. Kind of the areas, just to give you a sense of, what do we invest in when we invest locally? We've invested in affordable housing. We've invested in affordable home ownership. We've certainly invested in helping charities or not-for-profits acquire land, do a renovation to their building, expand their business. We've done that in the arts sector. We've done that in the human and health services sector. And in keeping with our conversation tonight, we've certainly done it in the environmental sector as well. So that's kind of the focus of that area. We currently have about $5.3 million outstanding in loans. That's 10 loans that are out right now. We have 3 other loans that are just been approved but haven't gone out yet for another 750. And important to know that over these 8 years, we've also had a return of our capital of $1 million. So that money comes back and recycles again into the community. And in certainly talking to our not-for-profit and charity partners, one of the things that really they appreciate about working with the foundation, besides our ability to be more flexible than a traditional finance organization, is the idea that the interest that they pay to us, in fact, gets recycled back into the community as grants. So it's a bit of a virtuous circle from their perspective, I think. When you look at the next circle around the mission, vision, and values, it's what we refer to as our national and global direct impact investing. Currently, we have approximately $22 million in commitments to those investments. Of that, about 8 million now has been called. When you think about those investments, the investment vehicles themselves, there's really a very wide and big variety of types of investments that we actually are engaged in. We have everything from guaranteed certificates of deposits, private equity, community bonds, and loans that we have done to various, and some kind of very interesting lending vehicles. And in fact, I think Trish will talk a little bit about one of those vehicles that we work with in CoPower. When you look at the areas of focus of that part of our investments, it again is very broad and quite diversified. We absolutely invest in sustainable development, both in frontier markets and certainly nationally and internationally. We do get involved in affordable housing funds on a national scale. We have a number of investments that are environmentally focused, some in the public markets, which John Cook will speak to. We certainly work inside of those investments to try to grow the market for impact investing. And we continue to see lots of opportunities in that market to make a difference. If we can't do that immediately in our current location, we certainly want to be able to do that nationally or globally. And then lastly, but certainly not least, we have a very significant public market fund. We continue to have 3 professional managers who we have oversight by our Finance and Investment Committee. We work with those managers closely. They are all signatories to the United Nations Principles of Responsible Investing, and our committee and their oversight ensure they actually audit the fact that they are signatories to the United Nations Principles of Responsible Investing. We use a third-party organization who actually kind of measures the environmental, social, and governance impact of those portfolios up against a benchmark. So we are not necessarily taking everybody's word for the fact that just because they've signed on to something, that they're in fact acting in accordance with that. And I think as good stewards, that's just part of what we do. So that's just to kind of give you a sense of what we're up to on the investment side and how we think about it. Our hope obviously is to continue to grow that local impact ring over time, and we know that will happen. We will see more loans to our community generally, and then also to continue to expand our national and global reach. So I think I will turn it over to Terry to introduce our guests.
Thank you, Annette. By the way, for those who aren't paying attention, there's good news and bad news. If you're looking at my peg leg, the good news is the surgeon, when he's finished, says I will have the ACL of a 28-year-old. The bad news is for Raptors fans, I won't be available for call-up for the game later tonight. So you're taking your chances. And Phil Redden, who just had a knee surgery, tells me that even old guys like us can survive and prosper thereafter. I do want to acknowledge my colleague, Colleen Mulholland from Burlington Foundation. Colleen, we not only work well together, we're at the bridge between our communities here tonight, and of course, we have a great history in that the Hamilton Community Foundation continues to take pride in having given birth to and supported along the way the great work that your foundation is now doing in our shared communities. So glad to have you and a number of your volunteers with us here tonight. So here's what we're going to do. I'm going to introduce in sequence 3 of our speakers. They're going to come up and spend about 10 minutes talking to you about their history with our impact investment, a little bit about the business that they're a part of, and why it matters. And again, this is one facet of our impact investing, but we thought what a great place to start with environmental impact and with the importance of thinking globally about climate change and emissions and a whole bunch of things that those of us who are parents worry about in terms of the legacy we're passing to the next generation. So our first speaker, without further ado, is Trish Nixon. She is the Chief Impact Investing Officer at CoPower. Trish leads a product development, fundraising, and investor relations department. She has spent a career working to accelerate impact investing, primarily in private markets. Prior to CoPower, Trish worked at Mars Discovery District. She's the 2016 recipient of the Edward Newton Award for Social Innovation and the co-recipient of the 2017 Clean 50 Award for Environmental Stewardship. Trish Nixon, the floor is yours. Come on up.
Thank you so much, everyone, for being here and giving me the opportunity to tell you what we do. And it's great to be here in Hamilton and speaking on behalf of the Hamilton Community Foundation, who have been long time and early supporters of CoPower. So at a very high level, CoPower exists to finance Canada's low carbon transition. And getting a little bit more specific, we set out to be a leading provider of finance for the distributed clean energy market and a trusted impact investment manager. So what is distributed clean energy? I'll start there. In essence, the way that we produce and consume energy is changing, and it's going from big and dirty to smaller and more distributed, and cleaner, which is great. Proven technologies like solar, like geothermal heating and cooling, a plethora of energy efficiency technologies and retrofits are helping our buildings and communities reduce their energy consumption and develop clean power profitably. But we're not moving quickly enough. I think we can all agree globally we're not moving quickly enough, and in Canada we're not moving quickly enough. And one of the primary barriers to deploying these clean technologies is access to finance. And so CoPower, when we started out, we noticed a specific gap, a specific underserved market. And that's in projects that are sort of under 20 million in capital expenditure and inside of the project. When you look at larger projects, large solar, ground mounts, big wind projects, there may be still, financing challenges and accessing financing, but there's a lot of bigger players who are there, who are at the table. The mainstream infrastructure providers are set up to do those large transactions. But there's not nearly as many players in the distributed clean energy market. And in particular, there's a huge move toward energy as a service, where some of these projects that are, may take some upfront capital. We'll use geothermal as an example. A residential home looking to be heated and cooled by geothermal power would typically cost $30,000 to retrofit. That leaves a lot of people out of the market. But new types of providers are coming in and saying, hey, we can be your utility. Instead of paying your traditional heating and cooling bill, we will be your service provider. We'll install the system. You pay us monthly payments over time, the same way you would your heating and cooling bill. These types of models are allowing these distributed clean energy technologies to be more widely available. But they require the upfront financing. And so that's where CoPower comes in. We work with clean energy developers and energy efficiency engineers to provide the upfront capital for their projects, primarily to date in the form of loans. So our flagship product is our CoPower Green Bond. Our Green Bond, which raises capital from investors, including retail investors, at a $5,000 minimum, provides senior secured loans to pools of these projects that are operating, that are generating steady cash flows and paying interest, 5 to 8% interest typically, from the sale of clean power or from the energy efficiency services. So we put together a portfolio of these investments, diversified portfolio, and then we try and make it easy for all Canadians to participate. So we've built an online investment platform, we registered as an exempt market dealer, and we allow any Canadian to come onto our platform from their kitchen table and invest in pools of clean energy projects. And through this sort of innovative capital raising system, we're allowed to, or we're able to connect smaller investors and smaller projects. We need, in addition to the retail investors, it's been very important to have the support of some larger early adopters like the Hamilton Community Foundation. So the first investment that the Hamilton Foundation made with CoPower was to a credit facility. We set up a limited partnership and Hamilton and a few other foundations provided a loan that allowed us to build our initial portfolio of clean energy loans. We used that to go and issue our green bond. We recently sold out our $10 million green bond that was issued in 2017. That was really started and catalyzed by that warehouse credit facility investment. As we continue to raise more money, place more loans, that pool of capital provides us the flexibility to draw down, to sign a term sheet with a clean energy developer, to do our due diligence before we go out and raise funds from retail investors. So it really is an innovative investment vehicle, and I'd be happy to share more, and we do have information about it on our website as well. And so that was about 2 years ago that we structured that investment. We've done a couple of funds previously as CoPower was developing, small private funds to kick off our investment business. But that really kickstarted what now is the main tenet of our business, our green bond, which continually raises capital and does more and more of these loans. And we're really looking forward to launching our next bond in a few weeks' time. I encourage you all to check it out. Visit copower.me. Everybody can become a clean energy investor. And those bonds are available again across Canada. We offer a 5% 6-year bond and a 4% 4-year bond, and really make an effort to engage our investors in what it is they're actually investing in, so they can see, touch, and feel the impact that they're having and understand how they're creating value. Just a quick sort of impact note, today CoPower has directly contributed to over 600 tons of carbon avoided and about 700 kilowatts of clean energy generated. So that's about 150 cars off the road for a year, 600 homes heated for a year, which is really exciting. We're just getting started. We're starting to build out new lines of business. Our goal is to really be a solutions provider across the distributed clean energy industry. So we started with our senior debt, which has specific strict investment criteria that we believe is suitable for our retail investor base. We've moved now, we're about to launch a project equity fund, which will invest and take ownership of clean energy projects. And we've built some institutional partnerships with larger financial institutions that are allowing us to do larger and longer term loans. So with those lines, we've become a serious player in the market, and I think accomplished, or certainly on our way to accomplishing our goal of being a leading provider of financing solutions to distributed clean energy projects. And looking forward to allowing and enabling and empowering more Canadians and more different types of investors to participate.
Thank you, Trish. That was quick and comprehensive. Not to throw down the torch for the subsequent two speakers, but that's a high bar. I'm going to call on Jen Baker next. And Annette talked about the loans that we have done mostly in this community to few in the Greater Toronto area, but mostly in Hamilton, to nonprofits and charities. And it's a cross-section of partners that have really added to the community fabric. And everybody from Indwell, who provide housing, to the hardest to house, the most vulnerable in this community, and have done it with great dignity and architectural rigor in a number of projects, to Hamilton Artists Inc., who took a burnt-out old retail space on James Street North and with a construction loan turned it into something that's an attribute to that neighborhood, to the Mustard Seed Co-op Grocery, and to the Eco Park. And what I think is really neat about Jen's work, and she has been a champion for environmental stewardship, for conservation of the natural attributes that we have here in the Hamilton-Burlington area. But this partnership that she will tell you about is unique in that it crosses municipal boundaries. So you have two municipal governments, Hamilton and Burlington, involved, two conservation authorities, Hamilton and Halton, the Royal Botanical Gardens, in whose property we meet tonight, and the leadership of Jen Baker. And she will tell you about a unique loan vehicle that allowed them to close on a couple of key acquisitions in knitting together the fabric of this brilliant vision that will ultimately preserve critically important piece of conservation land for the future of all of the citizens of this community. So with that, Jen is a longtime volunteer with the Naturalist Club, and for the last 7 years has been their, I think, sole full-time staffer, driving both their land acquisition and their land stewardship programs that have contributed so much to our region. Jen Baker.
Thanks, Terry. Hi, everybody. I know some of the faces and hope to meet some of the others. I have a completely different story to share with you tonight. And so first, I wanted to tell you guys about the Cootes to Escarpment Eco Park system. So for those who aren't familiar with it, I know that some of you are, but it's an initiative of conservation partners that are working to protect, connect, and restore natural lands in the eco park system. And and everybody's saying, what's the eco park system? Where is it? We're in it right now. So thank you for that. And it stretches kind of from this area, encompasses part of West Dundas or East Dundas, and goes into Burlington just before Brant Street. And then the critical thing is it connects Cootes Paradise up to the Niagara Escarpment. So it's kind of that general area that we're looking at. It's about 10 years now that 9 different partners got together to look at what can we do to work together to protect natural lands in this area, as well as to take care of them. Because sometimes the protecting them is the easy part, but then once we protect them, we have to take care of them forever. And forever is a really long time. I'm with the Naturalist Club, and we turn 100 next year, and we still can't really comprehend forever. So, okay, and so Terry had most of the partners right. I'm just gonna.
I never let the facts get away.
So we're gonna just add a couple more. So there's the Naturalist Club, there's Hamilton, Burlington, there's also Halton Region, RBG, McMaster University, the Conservation Authorities, and Bruce Trail. So getting together an MOU was a feat. We all pat ourselves on the back for managing that, and we're all still working together. And what we do is we protect land. I'm going to tell you about that story in a minute. But we also share efficiencies to take care of our lands. Some of us are charities, don't have a lot of resources. We have to be as efficient as possible to take care of the lands that we have. And so that includes, we'll go tree planting. We'll work on managing invasive species and then replanting it with native species to help take care of our natural history. So those are some of the things that we do in working together. We also work to acquire lands together. And so why are we doing this? What's the key? Who cares? That's nice, protect land, whatever. So why we're doing this is this area is really, really ecologically significant. So for those of you who didn't know, and if you're from the area or the region, we have something really critical that we can be so proud of in terms of protecting this area and taking care of it. Because what I find that's really exciting about all of this is that we still can. It's not too late. We still have lots of areas that we can protect and that we can restore and create this truly remarkable system. And why we're doing this? Well, it's the natural history. Lots of you know, you go for hikes, it's kind of just intuitive. This is just a great space to be. You go paddling in Cootes for an hour, you see more species than you're gonna see in Algonquin in a month, because they're all compressed into this small area that we have already made sure is protected. Because of the Niagara Escarpment, so not only is the Niagara Escarpment unique in Ontario, but we're even more unique. So people in Burlington call it the escarpment, people in Hamilton, we call it the mountain, same thing. But what's unique about the escarpment here is it's a south-facing slope. That's unique. There aren't many south-facing slopes along the whole stretch of the escarpment. We have one of them here. That means there's lots of different habitats. It provides all kinds of different little niches and stuff for different species. Where you have lots of habitats, you're going to have lots of critters. So in this area, we're like the most biologically diverse region in all of Canada. That's pretty impressive for being in such a built-up area. So the biologists and ecologists have listed over 1,500 species. So that's plants, animals, mollusks, stuff we didn't even know existed. They found it and it's here. And of those, about 50 are species at risk. So that's pretty significant. That's why we're doing this. That's why all of us work so hard to take care of our spaces and then work on protecting more when opportunities arise. Like that kind of just sets a tone there. It also provides us really cool places to go and to visit from our, from a human point of view. So we're talking about these parcels of land that we've protected. So now the story about the land. This is an area of Dundas called Pleasant View. Some of you might be familiar with it. It's along York Road going in from Highway 6, the farm fields that are there. That area is so significant for wildlife. It provides the only or the best corridor going from Cootes Paradise up to the escarpment because there isn't a big highway in the middle. So wildlife actually can move back and forth. Conservationists knew this area was significant for decades and decades, but the developers who owned the land didn't know that it was so significant. So many development applications were put forward over decades, over this whole big area. They were turned down. Conservationists went to the OMB and won, which doesn't happen very often that conservation wins at the OMB. But still, development applications were coming forward. And really, if you want to protect land, the best way to do it is to buy it or have it donated or something. But get it under your ownership. Best way to make sure it's permanently protected. So we knew we had to do that with these two parcels that total almost 100 acres. So it's a significant chunk of land when you live in such a built-up area like this. 100 acres is pretty rare. And so we were talking with the landowners for decades, and eventually, after many years of negotiations, we were able to come to a purchase price agreement that fit with our appraisal. Because we have lands appraised, we have to stick with the value that independent appraisers put on the land. So we were able to reach an agreement, reach a purchase price, so we're able to protect the lands. This is way too big a deal for any one Cootes to Escarpment partner to take on themselves. Way too big. We came together and we're like, hey, this is the area that Cootes to Escarpment started in the first place. We are going to get these lands protected. So we did, we signed the agreements. We had RBG take title to one and Conservation Houghton take title to the other, because even though we're all working together, somebody still has to sign the piece of paper. And so we had all of that, and then we were like, okay, so now how are we going to pay for it? We kind of had ideas, but we weren't too positive. So fortunately for one parcel, Royal Botanical Gardens had actually gotten a really significant endowment bequest, so I was able to pay for a big chunk. And then I called Terry. And I said, Terry, we need some help. So HCF worked with us to find some donors who would donate, and some of you are here, and we're so appreciative of your donation to help us secure this land. And so we were able to and with support from the Naturalist Club and other C2E partners, we were able to fully protect one parcel. We still had the other parcels. So again, HCF donors generously came forward, C2E partners like the club, so we're invested in both properties, came forward, but we still needed more help. And so I've been talking with Terry a couple of times about the impact investing in case things like this came up from the club, because we also buy land and make sure that it's protected. We've been doing that since 1961. And when land comes up, you have to go. You have to be able to jump on it because that opportunity might not come up again. And so we had already been talking. We thought, oh, this is a perfect opportunity to get this land protected, raise more awareness about the impact investing, and not have to go to a bank to be able to do it. So this is what we did to buy that second parcel. Is, you know, again, we have to have somebody sign the paper. So it was Conservation Halton who did that for that property. And we were really lucky to have the support of HCF, because the grants that they talked about, that's usually what we do. So this is a whole new world for us. So HCF was really helpful in like holding our hands and making sure that we were comfortable, like that all the partners understood that what was going on and what would be happening and what the requirements were. You know, make sure that the Conservation Halton finance people understood what was going on and what the requirements were. And it was a really friendly loan. And now Terry's incapacitated, so we're good. But really friendly loan that we could pay off in lump sums if we got generous donations, or over time, as you know, like whatever was best for us at the time. So a really friendly arrangements, which means that all of us can keep doing what we do and all the good work that we do, because we can't put everything on hold. So, you know, but then we can keep plugging away and making sure that you know, the loan is repaid over time, and hopefully we'll be able to repay it quickly, because there are other properties that I want to buy, and so we need that to be done first. And we can say that without HCF support and without this would not have happened. Nobody would have been comfortable enough to have their organization go to a bank for a traditional loan. We wouldn't have been able to do that. So this property could have been developed if we hadn't been able to buy it right then. And instead, now it's protected forever. You know, nobody can take it away from us. And there's huge, if you guys go by the area, there's fantastic restoration work happening there, with even more coming this spring. So it's going to be super exciting to keep an eye on those properties. And so that was kind of the story, very different, which is neat working with HCF, because I know I'm familiar with lots of the local partners that they support, and it's neat how many different parts of our community are supported. So thanks.
Great job, Jen. I have bad news for you though. We're in the hammer. Collecting is never a problem. And if it is, you get new kneecaps. It's very simple. I have friends that can take care of these things. And the reason I forgot the regional government in Halton is in a previous life, I blew up a regional government. I've erased that from my memory bank because I wake up screaming in the middle of the night. Our third presentation, again, will be significantly different. And that's one of the unique things about impact investing. I want to introduce to you John Cook. No relation. He doesn't even spell his name right, but he's a good guy. He is the Chief Impact Investing Officer, he's the President of Greenchip FInancial Corp. And prior to joining Greenchip, John was President of Mars Discovery District, where he led corporate development and strategy from 2001 to 2005. He's also held executive positions at AIM Funds Management, Inc. and BPAI Financial. And John, I think it's fair to say this has been a great partnership and investment for us. So please come and address us.
Thanks, everyone. I don't have any notes. I'm going to try and answer the three questions that you said. I just want to start by just the two speakers that came up before me. Trish, we were on an impact investment panel about 5 years ago, And I remember calling you up afterwards. I just thought your presentation today was fantastic, and I wanted to congratulate you on what you've done. This is hard sledding sometimes, and I just think it's amazing what you're doing. And Jen, what I always say about our space is there's sort of like the 3 R's of education, there's 3 C's of environmental sustainability, and it's conservation, carbon, which I don't think we're going to talk about today, but you can see from what Trish talked about how it's tied in, and finally capital investment, capital allocation. And if I was going to talk to your first question, what is the big hairy problem that we're trying to address? It's related to capital allocation. When I finished up my time at Mars, I was introduced to a couple, Greg Payne, my business partner, is an economist, a couple other guys, and we all sat down and we decided that capital wasn't being allocated the way that we thought it was. And the one thing that was very clear to us is with an economy that was sort of globally growing at 3% a year, you just couldn't take that off to infinitum, that at some point we were going to, on a finite planet, run into finite resources and a planet that was certainly running into ecological limitations. And so we thought that capital needed to be allocated differently. And I'll tell you what we do in 1 second, not nearly as eloquently as Trish did, but I just want to put some numbers to the scale of that problem. You know, the International Energy Agency suggested fairly recently that we needed about $2.5 trillion a year for the next 25 years to have any chance of meeting the 2-degree target that was set out by Paris. And last year it was 1.1 trillion. And that's a pretty significant gap. So that's at the highest level. And what we're talking about here is investment in renewable energy, but also all the efficiency, energy efficiency and resource efficiency technologies that we can put into our global industrial economy. So that's the gap. The one that really stuck with me, I was at the Globe conference in Vancouver 3 weeks ago, and I met with the chief investment officer. We only have 2.5 employees, so you can call me whatever you want. He said something that really shocked me, that the R&D expenditure at Google and Amazon, which I came back and checked out, was $33 billion, exceeded all global clean tech R&D in the world. Think of those 2 companies, what they do. Like, one is like what is Google? Whatever, it doesn't really matter, right? Like we know what Google is. But Amazon is sort of a Uber retail outlet. If they're spending more in R&D than all other clean tech businesses worldwide, I think that says something about how little capital is really going to solve these great challenges. And the one area that I would say is an exception would be battery technology. We're really not there on storage technology yet, and it needs a lot of research. But boy, we see so many more in what we do. So that's the big hairy thing that we're trying to fit. The challenge is that the largest investors, we don't have a retail product. Our fund is only available to institutional or accredited investors. The big challenge is that these accredited investors, they don't have any box for sustainability. They don't know what to do with it. As you said, Annette, they've really focused on this idea of ESG, environmental, social governance factors. What that really does is it focuses on how companies behave. So, and this is important, you know, to make sure that we don't have kids working in factory lines, that our companies are paying attention to the environmental impact that their business is making, and so on. What we do and what our business focuses on is what companies actually produce. So we set out to invest in this global sustainable economy. We identified about 800 businesses that were, in our view, on the right side of the great energy transition that Trish talked about, and from those we would pick 30 to 35 businesses. But we focused on the products and services that they produce. And this is what we need our largest pension funds and large pools of institutional capital to do. And so if I was going to talk about the impact that I think we're making, it's to try and provide some leadership and some space in the marketplace that it's okay to actually consider other types of investment products, that you can't just focus on global equity and that's the box, and you're going to interview 10 managers and pick a global equity box. Or you're going to, if you're even larger, maybe focus on some sector of the economy. That the idea of focusing on more sustainable investments needed a place within these large pools of capital. And the impact or the connection that we've had with Hamilton, and I just want to put in perspective before I tell you that, is what you see here is really very progressive in my view. I think it's all the power to you guys, and I know Bill and many others on your committee have been involved for years, but what we saw early on, you know, I'm going back to about 2010, 2011, were these pots of money that foundations had, and they were allocating these little thin slivers to create mission-related investments from, but they were totally separated from what the foundation's missions sort of were. The rest of the money that Bill Young was talking about before, challenging you on, was really, it wasn't getting the same attention. And so I think to put the mission right at the center of what you're doing is, and I'm not seeing it everywhere else, I mean, you've been doing this for a while now, but this is really quite progressive. Anyways, we need more progressive thought on how we're going to allocate capital. But coming back to what Hamilton and our relationship has been, in 2013, when we were about $15 million, and I could barely get any audience with the largest pension plans we were trying to talk to, Hamilton stepped up and made an investment in our company. It gave us a jump. You told us that we could use your name, which now we have 15 foundations and endowments. We have 2 universities that have invested with us. And now we're getting invited to go and talk to not only other pension funds in the country, but other universities. We had a research contract with BC Investment Management, which managed 30 pension funds in BC. And they're not all going to invest in our fund, but I think we can attribute a little bit of that space opening up to what we're doing. So that's really the impact that the Hamilton investment and what we've been doing is, and the one thing I'll just, because you can't buy it, it's really for institutions. What we've also showed over 10 years is that you can actually do okay investing in this stuff. Our fund has outperformed the broadest index, and that's when they start listening. It's so on many levels, I feel like maybe not as exciting as your story, but we're getting there. Is that good? Okay, thank you.
And now I'm going to ask all 3 of you to join me in the hot seat up front. And this is the interactive part of the program. And recognizing that there are very few shrinking violets in the audience, let me open the floor to questions. I'm going to use the moderator's prerogative first, though, because as a foundation, and you know, to his credit, Bill Young, when he challenged us, one of the things he said was, for a private foundation, because Bill's had a private foundation, you could do whatever financial heresy you wanted to. But as a community foundation, you have a much broader constituency of stakeholders, and you better make sure that you're not marching too far ahead of the parade. And part of that sell is that we're not a bunch of granola eating folks who are simply interested in the environment. We also are very disciplined and careful about who we invest with and what the financial return is. And our proposition, as I said earlier, is in fact, we think we can do that without conceding financial return over the long term. But I'm going to challenge the audience, because John, I'll start with you, because during market downturns, the stuff you were doing during certain cycles in the market wasn't always rewarded. And how do you instill that kind of patient, long-term vision that recognizes the way in which you're investing the assets of your institutional stakeholders, and recognizing that they're not always as patient as we might want them to be?
Yeah, it's a good question. Can everybody, grab it? I'm usually loud enough. You hold that. Yeah, everybody can hear me, right? Okay, so I think one of the things that you have to do is open space for yourself by only attracting patient investors. And that's one of the things when Greg and I started this business, I came from a retail investment background prior to Mars. And retail investors do tend to be a little bit more emotional and tend to move a little bit more quickly. And I hope there aren't any financial advisors in the crowd, but sometimes financial advisors encourage them to move more quickly than they should. So one of the things we set up to do is create an asset base that actually was patient and would give us time. And one thing I would say about our space generally is it hasn't worked so far just to take the thesis that companies that are in renewable energy or batteries or energy efficiency are going to grow faster because of the drivers that I talked about before. They actually haven't. The companies that have done better have been finance, healthcare, and the Googles and the Amazons of the world, those sort of consumer technology companies. I think that will change, but what you're talking about is a period early on where the capital-intensive investing that we were doing from sort of 2007 to 2011-12 significantly underperformed. And the other thing I would say is you've got to just get back to the basics of investing. Like, what are you paying for the cash flow that a business produces? Whether it's a GIC or a bond, there's a price that you pay for yield. If you look at businesses like that and apply that discipline, I think in the long term you win. Take your time, stop paying attention to the price movement of stocks and focus on the valuation of businesses. And I think that's how you do it, just being disciplined. Right?
Sure, I'll jump in. And I'd like to point out that Bill Young invested in CoPower's very first fund so that we could prove our track record before Hamilton came in. And I don't think he minded me telling you that. But, hello? There you go. Sorry about that. Yeah, I mean, I think that, so CoPower is focused on private infrastructure investing, which means we're a natural, we reduce volatility in your portfolio because our returns are generated from the sale of clean power or from energy efficiency services, and they're not, they're uncorrelated to broader public markets movements. So right there, I think, is something that not every retail investor thinks about, not every investor thinks about. And one of the things that is really great about working with HCF is that they do take, as you can see from an impact perspective, but they take an approach where they're looking at different asset classes and what are they trying to achieve with this investment. So very recently, or I guess can I talk about the approved investment? Okay, so HCF is just about to invest in our green bonds, which, as I mentioned, is a 5% yield, a strong competitive return for that, has a track record. We've never had a loan default. We've always met or exceeded returns on our investment. So strong yield on that product within a private debt vehicle. The credit facility that they invested in was a little bit different. So again, this was sort of a catalytic entity that helped us get our green bonds to market. It is actually, when you were talking about when you need to buy land, you need to buy it now. Mm-hmm. Same goes if you need to finance a project. The developer is not going to wait for you. If you need to sign, you can't sign a term sheet and agree to finance a project and then say, but I have to then go raise the money. So we needed, flexible capital to help us do that. And again, that it really is the engine that makes our bond product function. But the way that vehicle works, we pay a 5% interest rate when that money is drawn, when it's invested in a project, which is an appropriate competitive risk return, at least from in our view and in HCF and our other investors' view. And then we pay a small standby fee when that capital is not being used. Which again, then when it's not being used, there's not risk. So a small, approximately 1% return, which would be similar to the cash that a large endowment like HCF would have in a high yield savings account. There's an appropriate risk return element there. And I do remember sitting with an Editarian. We'd structured this vehicle initially with the McConnell Foundation. And I was sort of expecting a little bit of pushback, or a little bit of making it a hard pitch, and the response was, right, risk, return, impact, it all sort of lines up, completely appropriate. Obviously then they did some due diligence, and we had the investment committee meetings, and Bill Young made us put a floor return on the investment. So there's an opportunity cost there, so we have a 3% minimum that we are paying on an annual basis. But again, I think it's really important for investors to say, for large investors, our large investors have the ability to and the need to invest in different types of products for different reasons, and to consider risk, return, and impact sort of in concert. So again, to echo John's point, I think HCF is really far ahead of the curve in this realm, and has really helped a lot of Canadian fund and investment managers, impact investment managers, get off the ground.
Thank you. Speakers, there's water here if you need it. And I am going to go to the audience now. Two comments though. One of the reasons we're able to be patient investors speaks to a history of good governance. And the other one is frankly a demographic timing issue in that our early boards were smart enough to set aside a very healthy reserve that has allowed us to weather every storm, cover our overhead and our renting for a number of years, and as a result, never sell during a down market. I think that's a luxury that this foundation has because it had stewards and governors who made thoughtful decisions all the way back to Murray Hogarth and Terry Yates' days leading this place, and that's position as well. The other thing is, we know that in the short term, cash is not an issue. We thankfully have the trust of 65 years of goodwill from donors who continue to leave us money, and as a result, we can be patient investors. And if not community foundations providing that catalytic effect, I don't know who is. We are here forever. We should be. Our investment committees have thought that way for a long time, to their credit. Celeste, you've got a microphone. Who wants to lob the first hard ball from the audience? Yes, sir. Do you want to just identify yourself?
Yeah, sure. So I actually...
The mic's coming to you.
The mic is coming. The mic is here.
So everyone, thanks for the discussion today. I know some of you have been in this field of impact investing for last little while. I actually work for the Kitchener-Waterloo Community Foundation, leading their consulting. I am as a consultant leading their impact investments. I also work for a private foundation doing almost similar thing.
Almond?
No.
This is not a trivia question, so go ahead.
So two questions. One is for John and Trish about the maturity and the future of the field. So I've been speaking to a lot of foundations, I've talked to a lot of people, private equity, Greenchip comes up. Almost every foundation I know is invested in CoPower. So that's great, but what about the future? And people talk about it the same opportunities, like it's literally the same opportunities on all websites. So that question is for to the two of you, the future. And Jen, this is from the Community Foundation perspective, that yes, there are a bunch of mission-related external deals that are available, that are tested. You can jump on someone else's term sheets and everything. But as a community foundation, you want to focus on problems of the community. And that finding the challenge around perpetuity and return, but helping the local organizations. So if you were to share top 3 takeaways from your experience to a community foundation, what would that be? So 2 questions, sorry for those long questions.
Would you start, Jen?
So 3 takeaways from this project specifically.
Or your overall experience working with, on impact investing, working with the foundation.
Okay, so this is my experience. I'm learning more as we chat with HCF. So I think 3 takeaways. So it's good, I think, for us to, so for charities, especially for smaller charities, to even be aware that these opportunities exist and that we can look at it too. Even though we're nonprofit, we might be looking at donors to help us repay the loan. It still provides an opportunity, especially when you need to act now. Like, could you imagine we spent how many decades trying to get the land and then say, oh no, hang on. We have to reach out, we need like 10 years to get the money together. So I think for us to just know, but I also think it's important that it goes to the responsible and credible charities in the community. So we have a long history with the Community Foundation. We have endowment funds at the Community Foundation that we keep building on. So we have worked. Well, I guess we're older, so we've worked with the Community Foundation since they were founded, and I think that's important too, because we have the reserves, we have the cash, we have the financial know-how, I guess, to take on something like this. This particular loan, it was conservation in Halton, but as the person who was negotiating everything kind of for everybody, I needed to have a bit of a background myself so that I could talk to the other folks in the room and talk to CH. And then also just from the club's point of view, you know, I would be comfortable entering into this kind of arrangement so say the Naturalist Club, if land came up, because I think that's the best example for us to enter into with this. If land came up that, like, there are some properties that I've had my eye on for a while, and the landowners just, they're not ready yet. But if they were suddenly ready, I am not losing that property because we're a small charity. That is not happening. So, but because, no, and you know, and we also have a history of protecting land too. So, but because HCF has been patient and explained everything, then I would be comfortable entering into that. But we're a long-standing organization. You know, we have our own resources behind us. We would just need a bit of help, almost as a bridge. And I know I'm taking a while, but I also just wanted to say one more thing. So HCF is my community foundation. I had no idea you guys were so progressive. Like, how awesome is that they're the ones that are my home community foundation? That's fantastic. I thought that everybody did this.
Gotta get Toronto catching up. They're working on it.
Sure. Well, I'll be really quick. Why there aren't more of us is because it's really hard. You know, this is not. I've definitely put more money into this than we've ever taken out, and we're investing in 30 to 35 liquid securities. Like what we're doing, I mean, what Trish is doing is really hard, and you know, I could argue social housing or some of the others are even more challenging. So I think that's the answer. And that said, I think it's really important in Canada, as we're still in the early days, that we make some of these work. And so I think some of this sounds self-serving, but I think some of the concentration is a good thing. You do have to remain focused, and you have to have some faith that you're going to pull it off. And if we were constantly, there's more than a couple, there's certainly, I don't know how many there are, but there's enough. But we can't have 150 in the country that just aren't enough. There's not a big enough pool right now. So that's that.
Yeah, that was one of the points that I was going to make as well, was just that, yes, you know, a lot of the foundations are invested in a lot of the same, particularly products, or, you know, invested with impact investment managers. But those funds, managers, products still need to go beyond the foundation universe to find capital. So I think it's a good thing that foundations are learning from each other, or looking at each other's pipeline, because not all of these investments are found in your traditional places. You're not going to your existing managers to bring you deal flow. So I would say that I'd agree with you that the concentration and the foundations, you know, supporting, you know, the organizations that are doing this and doing this well is a good thing. You don't need to all be doing things differently. There's great models. Side note, when I was at Mars Discovery District in the Center for Impact Investing before I joined CoPower, and I used to steal the Hamilton's Foundation slide when I was going and talking and educating foundations on mission investing, because I just think it's such a fantastic model. And actually that brings me to the second point I wanted to make. So when I was at Mars, and the Center for Impact Investing has sort of been a convening center in the impact investing world to a certain extent, and I worked with foundations and investors, and yeah, I was a little bit frustrated with the lack of product. There's you know, we were trying to accelerate activity on both the capital side and the product side, or the investment side, but there weren't enough intermediaries facilitating, bringing together the money that really wanted impact and return with the sort of on-the-ground opportunities, which really is why I joined CoPower. Saw an opportunity to do something, and we were a very young company at the time. I essentially joined the two co-founders, and we built up, it's been about 3 years now since I joined, and about 3.5 since the company was founded. but just to do that, there's a real market opportunity, and I'll use CoPower as an example, but to serve an underserved market and deploy more clean energy. There's investors that want green, they want yield, they want impact, and they want yield, they want returns, and they want security, and here's an infrastructure class. So our value becomes, okay, let's turn this into a product that works for investors. And we've iterated a little bit, and I think we've hit on something really special in terms of our green bonds, and I'm really excited to now launch the next product, which is our project equity fund. So it'll be a higher return vehicle, open initially only to accredited institutional investors, and down the line potentially to retail investors as well. I guess that's one point I'll make too is that investment or fund managers, as these groups do well and grow, they can actually bring new products to market as well, not just single funds. So I do think that we're seeing more and more. I've seen more and more participants, certainly in my 7 or 8 years in this space. It's a lot more than there were.
Thank you. Just a quick observation, because the first event I attended in this role as CEO was in fact a Mars National Social Finance Conference, and I think at the time there might have been 50 people in the room, and if we go back to the same event today, there's 800. We knew, because we looked at the Heron Foundation in the US and the Nonprofit Finance Corporation, that there was a viable business model to do this stuff, but what was lacking was deal flow and good intermediaries, and we've seen that change fundamentally. The quality of the deals we're seeing is excellent. I would again give our board a shout out, because in the early days when there wasn't sufficient local deal flow, especially from charities and nonprofits, they said, you know what, if we can do a good affordable housing project in Vancouver, that's a good thing for Canada, and ultimately we hope those partners may come and do something in Hamilton. That's proven to be the case. When we helped to finance the Evergreen Brickworks in the Don Valley, some would have said, well, what are you doing underwriting good environmental sustainability in Toronto? You're from Hamilton. Ultimately, not only did we get the Toronto Foundation and others to come and syndicate with us, but in fact, Evergreen has now done some significant work in our community. And we're seeing that over and over. And I think that takes a board that says, well, we may be place-based in Hamilton. Ultimately, we're Canadians and we're citizens of the world, and we should be doing the best we can in all of those jurisdictions, and be confident that over time that will pay dividends in this community. And I think that's proven to be the case.
We did, sorry if I can say one thing. I know I'm talking too much. There we go. We did our first investment in Hamilton, solar investment in Hamilton a month ago, and it was about $1 million loan, and we've got another $10 million pipeline in Hamilton over the next year or so. So actually, Hamilton, and that wasn't the intention, but will actually be a big part of our portfolio.
There you go. Well done. I'm going to go back to the audience. Dennis, you look like you're incognito with those dark shades. I'm a little worried about that.
Sorry, Mike. Are we at a tipping point yet for the movement? If not, what do we need to do to get there?
Okay, depends what you're talking about in terms of the movement, but here's a couple of points. I think we're at a tipping point in terms of the institutional investment in more sustainable capital flows. Last fall, La Caisse de Dépôt made an announcement that they were going to double their low carbon investments. They had $8 billion in low carbon investments to $16 billion by 2020. They were going to decrease the carbon footprint of their overall portfolio, which is like $200 billion, by 25% by 2025, and follow the task force recommendation on carbon disclosure, which came out last fall, led by Michael Bloomberg and Mark Carney and a few other Canadians like Jane Hampshire and so on. Because of our relationship with BCIMC, I heard that the CEO said, what are they doing? Like, we should be involved in this too. Are we falling way behind because they were early on? And so they will be releasing their climate risk analysis in the next 2 months. We saw OP Trust about 6 months ago release theirs. And responsible investment paper came out from Ontario teachers last week or 2 weeks ago. So I think we're getting really close. And in lots of ways, Canada is way behind in this stuff. So, I mean, Europe's way in front, and spots in the United States. So I think we're getting close. At the same time, as everybody here knows, I mean, it looks like Canadians are having a really tough time understanding a price on carbon. And I mean, we won't get political, but this is sadly for me and maybe some here, this is playing to the worst parts of the sort of populist movement, and clearly Donald Trump has done everything he could to work against. But just so you know, like, I've seen ebbs and flows just in the 10 years that I've been involved. Don't get discouraged, it's going to happen, but those three pieces, conservation, capital, and carbon, they're all gonna work in ebbs and flows. And as you said earlier, there was a tough time for capital in our space. Solar was hugely overpriced when we started. It went into a real dip, and now you can pick up, you know, you could buy 100% of the global solar module manufacturers for less, like the market cap, the price of those stocks times all the stocks available, for less than the top 10 marijuana companies in Canada. Just to give you an idea of how cheap that sector is. There's some really exciting things happening. So, anyways, there you go.
I'll just add one thing in terms of the tipping point, which is, so we're making strides. I don't think we're at a tipping point yet, although there's certainly a lot more interest from institutions and mainstream investors. Every single person, institution, any type of investor needs to push their managers, their advisors. They need to ask them, what are you doing to invest sustainably, to invest in impact? How can I participate? Because client demand is what's going to drive this. So everybody in this room has homework.
Right, yeah, no, that's really important.
I'm going to take one or two more, and then we're going to wrap it up with time for folks to mingle and talk to one another. Rick.
Thanks, Terry. I have a personal struggle, which I'm sure a number of people in the room will share with me, and that is I commend everyone on the panel and the efforts that you're doing for clean energy. But how do you help me deal with the Chinas of this world that totally destroy what we do in minutes?
Okay, so you know, China, it's hard to answer it in just one sense, but I'll tell you some of the great things that China is doing. So there were 98 gigawatts of solar installation in the world last year. That was up from 75 the year before and 50 the year before that. 50 gigawatts of that solar installation took place in China. In the United States, it was 15. In Ontario, we have about 4.5 gigawatts of wind and about 500 megawatts of solar. You know, for them, it's sort of an existential thing. Like, they have a huge percentage of their population, which is a huge part of the population living next to coastal waters. In the large cities, they can't breathe. So it's not just solar. The environment is absolutely front and center in not only policy, but also in terms of economic opportunity. They're putting us all to shame in terms of, well, Elon Musk makes his smoke show, in my view, around the electric car. CATL and BYD in China, you know, have several gigawatts of battery factories, and the battery car is actually the car in China, whereas here it's sort of a fancy $120,000 car that you know, only a few of us could ever dream of owning. So, you know, I understand that China is making a sort of mess of the planet right now as they go through their industrial phase. But I think there's a lot that they're doing that's really right, and they are becoming leaders in a lot of the industries that we need on this planet. And I see us here actually falling far behind. Really in Canada too, we have really fallen behind in this space, which is very sad.
I'll take one more.
So when you invest, I guess, with John or Trish, how do you make it really a compelling kind of elevator speech to you know, people who've invested in endowments that, you know, we've invested in your fund and the following impact has occurred, and maybe just to thread Jen, because it's just too obvious the impact that getting those properties is. Could you explain how dealing with the foundation rather than approaching a bank? Like, what was the difference for you in not having to try to deal with a big, scary financial institution?
Okay, so the difference for me personally was that I could be honest and say, I'm so not a financial person. Please explain everything to me in very, very simple language. So I could be honest about that and say, like, we need something for the long haul. And going to a bank or a traditional institution, it just wouldn't have happened. Nobody would support that. So as staff, none of the partners as staff would have even brought that forward to our boards. And our boards would have just shut it down because we can't get the same kind of rate and the same kind of flexibility and everything. And it's more of a risk. And so for me, a lot of what I do is to make sure is it in the best interest of the club. And I wouldn't have pursued it, and the same with the staff from all the other partners.
So great question. And CoPower has, as I've sort of mentioned, a variety of different types of investors. And so, it does change a little bit talking to, the individual retail investor that's, excited, and this is the first opportunity they've had to invest in a clean energy project or clean energy product with foundations. But really, so we have an internal impact framework, and it really resonates, I think, with foundations. The reason, from an impact standpoint, I mean, we're a for-profit social purpose business. We are there's a market and financial opportunity here for us and for our investors. But when we talk about impact, we talk about three things. First, direct carbon reduced. So we are tracking and measuring the carbon avoidance using standardized metrics of every investment that we make. We report on that to our investors. Second, a little bit harder to measure, but is our market building. So I mentioned we're facilitating more energy as a service models. We're working with developers to deploy more projects, to improve their business models, to provide financing that might not have been there before. And so we view ourselves as having a particular role there in building out the distributed clean energy market in Canada. And then the third piece is the democratization of impact investing. Really important to us to empower all Canadians and everyone to participate in the low carbon transition, both for profit and planet. Foundations who are doing impact investing, at least HCF and certainly others, really like that. They like that we are making these opportunities more broadly available. And it's good for CoPower too. It's great for our brand. It's more expensive to bring on small retail investors than it is to talk to larger accredited investors. But we're building a really strong network of really loyal investors who are paying attention to what we do, who will continue to hold us accountable to the impact. And so there's the elevator pitch, which might change depending on who I'm talking to. And then we do really use our platform and our technology to demonstrate that on a regular basis. Our carbon reporting is right up next to the financial reporting on every investor's dashboard. We share stories about the investments that we're making, the impact that we're having, the number of investors. We've got over 400 investors now accessing our products through our platform. And so we track all those things, and we tell the stories.
Last word to you, John Cook.
Yeah, and I had the luxury to think about that for a minute. I think I'm terrible. I wish I could tell you. This isn't false modesty. I feel like I've been a complete failure because it's so obvious to me the capital needs to go to the space, and $70 million after 10 years. When AIM was actually, we bought Trimark, so that's Trimark. We used to bring in $70 million by lunch every day, and it's taken me 10 years to get to here. I think all you can do is be really honest. In this business, I think you have to be really honest to be successful. You have to do your best to, be patient and disciplined around your process and stick to your process and make good investments, and hopefully it works in the long term. But I don't think there's an elevator pitch that for us will work, sadly.
And on that great question and that great answer, we're going to bring our discussion to a conclusion. First of all, let me thank all of you for coming tonight to be part of a learning session together. thank all of you that have continued to contribute to our communities and to our community foundation and make it as strong as it has become. I can tell you for us that we certainly have learned some things along the way, and one of the things that we spent a lot of time with our board and investment committee doing is saying that just as in the public markets, we occasionally guess wrong and nobody can forecast with precision what the future is going to look like, so too in this space we'll make some mistakes. And our obligation is to tell you about those learnings, to learn from the mistakes and to get better as we go along. What I know for sure is that the license to make this journey as a foundation has immensely strengthened our relationships and our knowledge across the country, but it's made us stronger and made our contributions greater in Hamilton, and for that we're really grateful, and I think we're lucky. I want to thank a couple of people on our staff who helped put this event together today, particularly Alan Enrique and Jill Anderson. I want to thank all of our other staff, Celeste Licorice, who helped with the microphone, Sherry and your team, and Tracy Barco for taping this. And in particular, I want to thank Annette Aquin for her continued leadership and her contribution today, and our panelists, John and Trish and Jen, for all that you're doing and for the great partnerships that we have formed. So with that, let me ask you to join me in thanking our panelists for the contribution. We hope that you will stay, enjoy the food and each other's company. One quick shameless sales pitch. We have our annual Vital Signs report coming up in partnership with the Hamilton Spectator. You're probably reading my friend Steve Buse stuff on a daily basis, but on the 30th of May, we will be front and center in the Spec with our annual report card on how Hamilton is doing. And on the 31st, we'll be having a public event at the Spectator Auditorium with a panel of experts talking about the different trajectory of key elements in that report. We hope you'll join us that night, and we'll hope you'll continue to come back and learn with us as we continue to try and strengthen this great community. Have a great night. Safe trip home.
Thanks, Jared.